A promissory note is a promise to pay a sum of money in the future. It's an IOU. A note without collateral is considered unsecured. A note backed by collateral with the word referring to a security interest or mortgage is secured. The note must state the amount of debt, interest rate, time of payments, and term of loan. Agreement for deed is also called contract for deed, land contract, or installment contract. And licensees may not prepare agreements for deed. Essential elements of a mortgage: borrower and lender legal names, signed by the borrower. Legal description: must convey security interests and must reference the promissory note. The parties to a mortgage is the mortgagor and the mortgagee. Ors give, e's receive. So therefore the mortgagor is the borrower. The mortgagee is the lender. It sounds like it should be reversed, so don't let it trip you up. Special provisions and clauses: you have acceleration, which means the entire loan is due on default. Prepayment: the borrower can prepay without penalty. And due on sale accelerates the loan if the property is transferred without lender's consent. Mortgage theory: you have title theory and lien theory. Title theory is legal title held by the lender or a trustee until the loan is repaid. Borrower retains equitable title. Lien theory: the borrower has possession and legal title to the property, and the lender has a lien on the property. Mortgage priorities: property taxes is first, second is special assessments, and then 3 is other liens that are usually based on chronological order. In the case of default, lender accelerates the mortgage and forecloses. The lender must produce the original note or an affidavit of a lost note. Average foreclosure time in Florida is 1,025 days. The property is sold at public auction. Lower priority liens are extinguished. The successful bidder at the foreclosure sale gets a certificate of title. Lenders not paid in full may request a deficiency judgment, and equity of redemption means that the borrower can prevent the sale by paying off the mortgage balance. Mortgage types: you have term, which they sometimes refer as straight, fully amortized, and partially amortized. A straight or term loan, common in development and construction loans. The balance comes due at the agreed end of the term. Fully amortized, paid off in periodic payments of principal and interest. And then partially amortized is where payments are made for a period ending in a balloon payment. There are also adjustable rate mortgages, graduated payment mortgages, reduction option mortgages, early payment mortgages, 15-year payment mortgages, 3% down payment, and buy downs. An adjustable rate mortgage is where the rate's calculated by adding the index to the margin. The index changes periodically, however, the margin does not. The 4 major indexes are 1-year constant maturity, yield of the U.S. Treasury securities, cost of funds, and London Interbank Offered Rate. Mortgages by purpose: purchase money, seller financing. Participation, equity kicker. An example is a shared appreciation mortgage. Blanket mortgage covers more than one parcel. Reversed annuity for elderly owners. That's not repaid until the sale of the property or the owner's death. Package mortgage includes personal property, and then home equity mortgage is a second mortgage from the bank. Conventional mortgage loans, they're not government insured like FHA or guaranteed like VA. They usually have a higher qualifying requirement and cannot be assumed by a new buyer. They are conforming loans that meet Fannie Mae and Freddie Mac standards. Private mortgage insurance is required for loans with higher than an 80% loan to value. FHA mortgage loans, they're insured. Borrowers pay mortgage insurance premium for loans with higher than 80% loan to value. There's also an upfront premium. Down payments are required at least 3.5% of whichever one is the lesser value, purchase price or appraisal. Types of FHA mortgage plans. Section 203B is for residential property. Section 234 is for condominiums. Section 245 is for graduated payment mortgages. And Section 203K is for construction loans. VA mortgage loans are guaranteed by the VA. Maximum VA guarantee adjusts periodically. Lenders will loan up to the amount with no down payment. A certificate of reasonable value, otherwise known as an appraisal, is based on an appraiser's estimated value. When a contract for deed is used to finance the purchase of vacant property, the buyer gets contract and possession, but no deed at closing. After the buyer makes all payments, the seller gives a deed. Licensees violate the law if they sell land with a blanket mortgage that can't be released for payment less than the buyer owes. Installment sales contracts are basically owner financing. Many sellers like to finance the property sale because of the favorable tax treatments. Additionally, the seller may receive a higher price and get a good interest rate. The Consumer Financial Protection Bureau has regulatory power over the Equal Credit Opportunity Act, Truth in Lending Act, Real Estate Settlement Procedures Act, Home Mortgage Disclosure Act, Safe Mortgage Licensing Act, Federal Interstate and Land Sales Disclosure Act, and the Fair Credit Reporting. The Equal Credit Opportunity Act prohibits discrimination based on race, color, religion, sex, national origin, marital status, age, receipt of income from public assistance programs, and applicant exercising any right under the Consumer Protection Act. The purpose of the Truth in Lending Act is to disclose credit cost to make comparisons easier. Cost of credit must be expressed as annual percentage rate. When an ad shows items such as down payment, interest rate, or monthly payment, a trigger term, the ad must disclose all the components of financing. It's better to write easy terms than 5% down. Residential loan underwriting. Application for mortgage, the loan app is processed, and the Fannie Mae desktop underwriter gives a pre-approval or not. Your credit scores, their most important factor of a credit score is the payment history. Income is verified, and then they apply the income to income and expense ratios. Here's an example of loan underwriting, income expense ratios. Buyers have a monthly income of $5,200. Other obligations are $412 monthly. Their monthly PITI is $1,450. What is their debt to income ratio? The total debt to income ratio is 35.8%. Total monthly obligations divided by Monthly gross income gives you that figure. 1862 divided by 5200 is 0.358. Loan underwriting income and expense ratios. These are the recommended ratios for applicants for conventional FHA and VA mortgage loans. Conventional, 28%, 36%. FHA is 31 and 43%, and then VA is just 41%. But VA does subtract the total obligations from the gross income. The result must exceed the amount shown in the VA table of residual income. Property analysis with the loan underwriting is the appraisal, the title examination, and the survey. The loan analysis is loan-to-value ratio, interest rate and discount points. 1 point equals 1/8% increase in yield for the lender. And this concludes day 4.